Hello everyone, welcome to October's market review. As usual, we'll be covering three main points for the overview. Stocks and bonds have fallen, and this is because of the first two main points that I will be covering. Despite the US election uncertainty, one thing is for sure, whoever is government in 2025 in the US, there will be increasing fiscal spending or government spending. And as a result, the US yield has risen. The rise in US yield have actually driven down both equities and bond prices. Secondly, because of Europe's weakness in earnings, it has also impacted the developed markets' equities. And finally, in emerging market, China, because despite having a hope for a strong stimulus, after its announcement on the details of the stimulus, it has been underwhelming. As a result, emerging market has also fell. Finally, in our last point, October serves as a reminder for investors that it is important to have your portfolio aligned with your wealth goals risk level, because for Index Plus, low risk, conservative and balanced portfolios with short-term bond funds, not only did it not have negative returns, it has delivered positive returns in the month of October despite yields rising. Now, without further ado, let's move on to our October market performance for our market indexes. Now, first of all, the US Treasury yield, which I mentioned, has risen by about 0.5%, thanks to a higher expectation of a fiscal expansionary in the year of 2025 and more. As a result, the S&P 500 index, which tracks the top 500 US companies, has fallen by 0.91%. Now, and furthermore, the Bloomberg Global Aggregate Bond Index, because of the rising yield, has also fallen by 1.35%. Moving on to Europe's earnings, the world's largest brewery, AB InBev, has actually fallen by 7% after announcing their earnings in Q3. Its revenue has actually missed forecasts. And furthermore, Lufthansa, Germany's flagship carrier, has also fallen by more than 3% after reporting its earnings as well. And as a result, you can see that the weaknesses in Europe earnings has driven the MSCI World IMI Index, which tracks developed market, and caused it to fall by 2.06%. Now, next, if we go to the emerging market, for China, as I mentioned, that because of the underwhelming stimulus announcement, major tech giants in China like Alibaba, Tencent and Pinduoduo fell on average of 11% in October. And as a result, the MSCI Emerging IMI Index, which holds about 25% of China stocks, has also been pulled down and fell by negative 4.4%. And overall, the MSCI All-Country World IMI Index, which tracks 99% of the developed market and emerging market, fell by negative 2.32%. Okay, now let us move on to look at dimensional equities versus the market indexes. For October, dimensional equities performance are roughly in line with the indexes. To give an example, the dimensional global core equity fell by 2.14%. The dimensional global targeted value fell by 2.22%. Now compared to the MSCI World IMI Index, which fell about 2.06%. So there is a slight underperformance for these two funds of about 0.1% roughly. Now if you move on to the emerging market, the MSCI Emerging Market Index, IMI Index, actually fell by negative 4.4%, but the dimensional emerging market large cap core slightly outperformed by falling by about negative 4.25%. Next, Let's look at our dimensional short-term bond funds versus the longer duration global core fixed income and the Bloomberg Global Aggregate Bond Indexes. Now, for dimensional global core fixed income and the Bloomberg Global Aggregate Bond Index, due to their longer duration, they are more sensitive to a rise in yield and cause their bond prices to fall higher. In this case, the global core fixed income fell by 1.68%, while the Bloomberg Global Aggregate Bond Index fell by 1.35%. Comparatively, if we look at the dimensional short-term bond funds, which are less sensitive to the rise in yield, in fact, has actually delivered positive returns. For the dimensional global short fixed income, it has risen by about 0.43%, while the dimensional global short-term investment grade has risen by 0.25%. This, in fact, has actually helped to dampen the losses for portfolios that hold them. What is the key takeaway for October? Diversifying across asset classes is important. However, diversifying within an asset classes is equally important. Bond funds in general, because of their low correlation with equities, have helped to provide a certain cushion when equities fall. However, short-term bond funds tends to offer additional benefits, especially in a scenario where we are facing this month, where yield has risen. And because of that, short-term bond funds have actually delivered positive returns, which help to dampen the losses for portfolios in October. And hence, it is important to constantly remind yourself that having a portfolio that aligns with your wealth goals risk level is important to manage your volatility. Now, I will hand over to my colleague Alvin to do the market debrief. Thank you.
Thank you, Choon Siong, for walking us through the market update for the month of October. Hi everyone, my name is Alvin and I'm a client advisor at Provident. So thank you for staying for the market debrief for this month's market update. So we know that the month of October has been a challenging month, not just for the equities market, but also for the bonds market. But as investors like yourself and myself, as long as we are invested into a risk-appropriate portfolio, we need not worry too much. But what is a risk-appropriate portfolio? Clients at Provident know that the advisors here, we go through great lengths to understand our clients, their financial situations, and the life goals that they are saving towards too. Why do we go through all that? It's really to find out these three things. Number one, their need to take risks. For clients with relatively simple life goals, but they have abundance of resources, then their need to invest is actually pretty low. The second point, the willingness to take risks. So some people, they are not so comfortable seeing their investment value go up and go down. Because they don't like this fluctuation, they might not be so comfortable investing into a portfolio with more equity inside. So we want to put them in the portfolio with more stability. And the third one is a person's ability to take risks. So there's a few layers to this. We want to understand, okay, so what is the time horizon this person has to save towards for their goals? We want to have a better sensing of their financial health. Do they have enough emergency funds to tide them through any unforeseen circumstances? Whether do they have their insurance in place, etc., etc. So once we have all these three ingredients or three parameters, we will then be able to build a portfolio for them. So you can look at this pie chart over here. So in our portfolio, it's mainly built up by using equities and bonds. And at Provident, we only use investment grade bonds for the bonds segment. So some people might ask, hey, why don't we consider adding things like high yield bonds or perpetual bonds into our portfolio? But the reason why we don't do that is because at Provident, we think of bond as a stabilizer of our portfolio. That's why we only use investment grade bonds. And bonds over the past years have done a great job of stabilizing our portfolios, as evidenced from the next slide. In 2018, what has happened was that we knew that what the market went through was that because of the US and China trade war, because interest rate was slowly going up already, we realized that a portfolio with 100% equity came down by as much as about 11.4%. Okay, so but if an investor was put onto a balanced portfolio with 60% in equity and 40% in bonds, the portfolio would have only came down about 6.3%, close to half of that of the equity portfolio. And if someone is on the low-risk portfolio with as much as 80% allocation to bonds, you realize that the portfolio only came down by about 1.1% in 2018. So the same situation can be observed in the year 2022. That's when interest rate started coming up again, and you realize the 100% equity portfolio came down as much as about 15%, whereas the balanced portfolio came down about 12.8%, and the low-risk portfolio came down about 8.4%. And this shows us that bonds, or the bonds that we have put into our portfolio, has done its job of stabilizing the portfolio, whereby when market came down, portfolios with bonds inside didn't came down as much. Okay, so for clients that need the money in relatively short time, we would likely have put them onto a lower risk portfolio with more bonds inside. And these clients would have a bit more assurance, because even though their portfolio have came down, it didn't came down as much as if you were to have put them into a higher risk portfolio with more equities inside. And clients with longer time horizon, they would have also been assured in their investments, even though they had went through corrections or they had seen their portfolio came down. Why so is, let's take a look at the next slide. The markets have generally rewarded investors that have the discipline to stay invested. So let's take a look at this chart of the MSCI World Index. Okay, so this is if you have put in $1 into MSCI World Index in 1970, that $1 would have grown to about $98 come 2020. And in between, the market would have gone through different events, such as high inflation rate, such as even the Iraq War, and even natural disasters such as hurricane, and the more recent COVID pandemic that most of us are familiar with. So you realize that despite all these different events, the market still went up. And why is it that market goes up in the long term? It's because of a few things. Number one, population growth. As the world population continue to grow, there's going to be growth in demand for goods and services. And as companies' revenue go up, their share price go up. Second reason is inflation. We know that businesses, they will keep their pricing in line with inflation. As businesses charge more for their goods and services or their products, their revenue go up and their share price go up. And lastly, as companies and businesses continue to innovate, find ways to make things more efficient, they can look at increasing their revenue, and hence their share price will go up in the long run. So for clients and investors into something that gives you market return, we can be assured that even though in the short term we see markets come down or investment portfolio come down, we know that in the long run markets will go up again. In summary, it's important that we invest with the end in mind. Remember why we are investing in the first place. When we do that, then we will be able to invest into a risk-appropriate portfolio, a portfolio that's most suitable to our unique situations. And lastly, when markets have come down, we can stay calm and know that markets go up in the long run, and markets have traditionally rewarded us if you have the discipline to stay invested even through market corrections or challenging times. I hope today's market debrief and market update has been helpful for you. If you have any questions, as usual, please approach your client advisor at Provident. Thank you for staying through the video. I wish you all the best. Take care and stay safe.